Hello everyone. Again, welcome back to your demo number 2 for the next chapter of your PM syllabus. I am again your CA Anshu Budhia and I'm here again with another topic so that we have even more detailed understanding of these chapters in PM. I have chosen two chapters today for a detailed understanding along with question solving. And these two chapters that I have chosen are very, very favorite hot topics for your section A and section B of your PM exams. Even when you are an MA student, I find them to be very, popularly asked and frequently asked for those students as well. And for APM students, I find that this would be a certainly good base to understand. Okay, so I am here discussing about your two hot favorite topics. One is life cycle costing and another is target costing. Both these methods, they prima facie focus on how would you do the costing for a product. Let's take an example. You are all crazy about Apple iPhones. I mean, I am also. We always wait for the launch, right? That when is the new series of Apple iPhone is launching. Now, do you think that the price at which Apple is entering into the market, it's always above 1 lakhs, right? When we compare it with other mobile phone providers, I think the companies, we find always Apple to be always selling at a price which is generally beyond the normal average pricing of the mobile phones, right? We do generally find them at the upper end only. But then, and we also know that Apple launches its products quite frequently. And so let's say Apple 17 got launched, Apple iPhone 17 got launched, and after that I think Pro Max got launched, right? So when Apple iPhone 17 got launched, the craze about that phone, the rush about that phone generally remained for roughly around 6 months, right? So if I say that, let's say Apple iPhone was launched, so I can say that the craze generally remained for roughly around 6 months, right? After which the craze got reduced a bit because on the newer phones, the competitors launched their phones, and of course with the lower pricing, then probably the people started rushing to those competitors as well, right? So Apple knows that whatever profits it needs to recover and whatever margins it needs to earn those margins in these 6 months only, and it really cannot afford that beyond these 6 months its planning should go. I mean, whatever it is earning beyond 6 months, because people do buy older versions also as they appear at a lower cost. But the point is, when it goes beyond 6 months, Apple knows that probably its sales will dip. So for it, the most fulfilling period is its 6 months. Now, why I'm discussing it? Because when Apple fixes a price, let's say it is fixing a price for Apple iPhone 17, let's say at 115,000, how do you think the price is fixed? Because for fixing the price, cost is also needed. Plus, so when Apple is fixing a price, do they only look at earning the profit from a single product, or the pricing is set by considering what all cost it is going to incur in the entire life cycle of the product, so that the price that they are fixing is ensuring with the expected number of units that they are expecting to sell, is ensuring that the profits that they are targeting are earned. So in the modern business accounting, we really don't do costing of a product on a per product basis. We do costing of a product on the expectation that what is the product cost going to be in the entire life cycle of a product. See, Apple iPhone generally has a monopoly in the market. because it is generally the first one to launch the kind of versions that they launch, and then the other competitors follow. So generally it is not having the difficulty of having a high price and then it can become too competitive and it will have a pressure to reduce it. No such thing is there for Apple. However, Apple needs to ensure that the 6 months period that they are getting, the entire profitability maximum of that product, you can say around 90% of the total profitability is recovered in this 6 months period. So then how Apple will fix the price? That is the question. So for that, Apple will follow life cycle costing. And what is life cycle costing? Life cycle costing simply mean that right from the time that the product is in the development and design phase, that means what initially normally what happens, there is an R&D team, research and development team. They will first do research over the product, that what is as per the market expectations, what is generally the kind of product that the people are looking for. So they would do a market research for the same. Let's say their researchers, they gave around 10 alternatives, out of which one alternative the entity has finalized, Apple has finalized, that they would go ahead with this version. The finalized version will then be developed into the final product, correct? And then the designing of the product will be there, prototypes will be created, and the product will be developed. Then it will be launched into the market, and after it has been launched into the market, the sales will grow and it will reach a maximum selling point, and then eventually it will start declining because people will go for other products, right? And eventually it will drain out of the market. So the life cycle would mean all these stages, right from the birth of a product till the death of a product. We use a term here, birth of a product and the death of a product. Birth of a product means the stage after the research stage. Okay, so birth of a product means the stage after the research stage. That is, you are in the development stage, wherein all development related activities are ongoing, like planning, like designing of the product, like prototype development of the product, all these, etc., etc. Okay, all the activities that you need to develop the product, they would start in this phase, that is just after research. That is when now the product is getting birthed, right? Now the product is going to be developed, because now we have zeroed down out of the 10 options one option that we are going to manufacture. So now it will include all the expenses for designing the product, for developing the product, for prototype, and for all the capital revenue, all expenses will be lined up here, right? All expenses. And then after a product has completed the development phase, this is number one, okay, that the product is in the development phase. After the product has completed its development phase, then the product will be introduced to the market. We are looking at the different phases of the life cycle of a product. What are the different phases? First, it will get developed. So understand that always a common mistake by the students, they always think that the development of a product starts at the research phase. But that's wrong, my friends, because development of a product will always start at the development phase, because when the product is in a research phase, we still don't know which product will be made, will be manufactured, so it is still not a certain product. Hence research phase expenses are never a part of the development expenses. Clear? Research phase expenses, I can mention it here. Research phase expenses are expensed off to the P&L account. So it has got no role here in the product costing. Okay, now you are in the stage one where the product is getting developed. Once your product has got developed, now you move to stage two. Stage two is introduction of a product to the market. Because now the product is developed, now you are going to start with the commercial production of it. So the product will be introduced to the market. So what kind of expenses will be incurred majorly in this phase? You will have marketing expense, you will have advertisement expense, the salary of the staff because operational expenses will start. So here mainly you will have the fixed cost to be incurred. Why? Because you're getting every infrastructure to be set up. So lot of fixed cost and lot of cost will be incurred. But you know what? In which stage you have the major cost incurred? The major cost is always incurred in the development and the design phase. Because designing, developing a product and planning for a product is the most substantial cost for a product. Most substantial. Okay. Now let's go to the third phase. So now the product has been introduced into the market, and now let's go to the phase number 3. Phase number 3 is the product has been introduced, it has started to grow, and it has reached a point where we say that the point is the maximum sales of the product. That means that point where probably in the entire life cycle the product is selling the most in this phase, the most, which is maturity phase. So here I've combined stage number 3 and stage number 4. Which are those stages? Growth phase is stage number 3 and maturity phase is stage number 4. Growth is that when your sales has now started picking up, they are slowly and gradually growing. You are now capturing the market, right? You're now capturing the market. You are getting the hold of the market. So your sales have started growing, your product has started growing, and now it is being received by the customers. So you can see the growth in the sales, right? Where you have not reached the maximum point, but the product is selling. For example, Maruti 800, it instantly comes to me. Always. There was a time that every household had by default the first car as Maruti 800, correct? So that was the time when Maruti 800 car sales were at the peak. Whichever competitor was there in the market, I think it was an Ambassador and Fiat, they always lagged behind Maruti 800. Everybody had a deep craze for Maruti 800. And then eventually when it reached its maximum sales, then it came a point where the sales started declining. So the company started with newer versions, LXI, VXI, UXI, and all that newer versions they came into place. But then also after some time the car sales were dipping gradually and went into too low that the entity had to phase out the product from the market, right? So Maruti 800, Chetak scooter, they went out of the market like that. But then they reached a point where almost every household had that product, the maximum sales, which is your maturity phase. So just think, when you're in the growth phase and maturity phase, which expense do you incur more? Do you incur fixed cost more or do you incur variable cost more? Because your sales are growing. Now you've already done all the setups. Now your sales grow. Now your sales are reaching the maximum point. So of course your variable cost will be, major portion of the cost here. Because as you have more sales, more variable cost. As you are reaching maximum sales, maximum variable cost. Because fixed cost is already incurred. So you really don't need substantial fixed cost now. Okay, economies of scale will come here because your variable cost is increasing, your overall sales are increasing, your overall your sales are increasing. Yes, so majorly cost here incurred is variable cost. Now you need to have hold of it because in your exams you are tested in the MCQs about the kind of cost that will be incurred in each phase, plus which phase will have the maximum cost incurred, like the design phase, in which phase you will find majorly variable cost incurred, like the growth and maturity phase, in which phase you will find majorly fixed cost incurred, like the introduction to the market phase. Okay, so you should be knowing about this logically. Now we have done stage 3, stage 4. The product has reached its maximum sales. After that, what is the next step? To phase out of the product. Because now when the sales start declining, then the product will be into the decline phase. That is the 5th stage. and the product will eventually phase out of the market. Okay, so the product will eventually phase out of the market and the product is in the declining phase. So which are the kind of costs that will be incurred here? So in this stage, you will find cost incurred like decommissioning cost. You will find here, disposal cost, dismantling cost. All these costs that you need to incur basically when your product is phasing out of the market. So that cost will be incurred here, right? All that cost. I hope you all know what is a decommissioning cost and dismantling cost. That is, for example, you are doing a real estate work. You have big cranes that are set up over there and that are fixed at that site. So once your site is over, now you need to remove the apparatus. So you need to dismantle the crane because it is so huge. You need to, bring them into multiple parts and then only it can be transported. It cannot transport like this, right? So this is known as dismantling and then the decommissioning of the plant and machinery, mines or that take place. Anyway, so that is also substantial cost. So that is a cost for your fifth phase. So here we have understood that the life cycle of a product, it spreads across 5 phases, right from the start of design and development and ending with the decline phase. Now, so I think we are very clear that all cost, and this is, I'm reiterating it multiple times because in your exam questions, you should never be confused about what cost will constitute your life cycle cost. Like it is very important to understand that. So all cost from development stage to phase out or decline stage will be included. All cost, whether it's a variable cost, it's a fixed cost, it's a revenue cost, it's a capital cost, all cost will be included. Remember that, all cost. Why not we do a question of it? So I will take you to my study text that is custom created by me. That is my concept and the course book. And in this book, we will take the chapter and we will do the questions. So it is chapter number 4th 52 page. Let's go to 52 page. Okay, so here it is your life cycle. You can see in your text I have explained them very clearly. Let's look at the phases again. So here also I will explain this flow chart again so that we are extremely clear about it. This is your first phase, like we discussed, the development and the design phase. This is your introduction to the market, growth phase, and this is the phase where your sales are maximum at this point. So it is a maturity phase and your decline phase. Look at the cash flow movements. Your cash flow is generally negative. You're not reached a break-even point also because when you're growing like a startup, right? When you invest, when the startup starts, in initial year it will have losses and the outflow will be negative. Yes. Yeah, not just the sales, Arana. Not just the sales will increase. Along with the sales, the cost will also increase, like variable cost, because you know that sales and variable cost are related to each other. So your variable cost will increase and your profitability will also increase because you will have economies of scale, right? When you produce more, when you manufacture more, your overall cost per unit reduces, right? Why? Because now, let's say you have taken a bigger space on rent. So when you produce it till the maximum capacity, then the cost per unit will fall down as compared to if you are producing only till 50% capacity. So as your sales grow, eventually your cost per unit falls. And when your cost per unit falls, then profitability will obviously improve. Your contribution increases, your profitability increases. Why? Because contribution is equal to sales less variable cost. Correct. When my sales are growing, your cost per unit will start to settle down, right? So because now you are a market ruler and you are selling a lot of units, so your contribution per unit may be less, but when you multiply it with the number of units, your overall contribution will increase multifold. Correct. Another point, see, like I told you, your fixed cost per unit will also start falling when your sales starts growing. because then you're better able to use the capacity, so overall cost per unit of the product reduces, so overall profitability will increase. Correct? So therefore, when you reach the maturity level, that is when your sales are maximum, then your profits are also maximized. However, when we study in pricing chapter, I will tell you profit is maximized at which point. Is it really maximized where the sales are maximum? No, it is maximized where you are. We will cover that portion again. Let me not mix it here, right? But Arana, I hope I'm able to clarify your query. No. So just look at the cash flow. See, in the initial time, like in the startups, what happens? When the sales start growing in the initial years, it takes some time to be coming to the positive cash flows, right? Because in the initial years, we have more of investments and more cash outflows that take place. So therefore, in the initial years, you will have negative cash flow. And only when your sales starts growing and you have economies of scale where your cost per unit starts falling, then you can see your cash flow also increase multifold, and you can see that when your sales are maximum, your cash flows are also maximum at that point. And also it will go on, and then after that it will start declining because now your product is not able to be sold in the market, it is not able to gather that much units. Clear? So you can see that fall which is coming in. Okay, one evaluation I have done for your exam perspective, very important. When we are in the development phase, the major cost is development expense, right? Research is, but research will not be coming here, but the major expense is this. When we have introduction to the market, sales volume is very low, and we will have very high fixed cost incurred here because you will have new setups, right? So new non-current assets, new major advertisement contracts will be entered into, so a lot of fixed cost will be incurred here. When we are in the growth phase, now your sales are increasing rapidly. Okay, rapidly they are increasing, so you'll have more of variable cost that will be there, and some fixed cost may also rise, because let's say now the space is becoming short, so I need to have more factories, more stores to be opened, so more fixed cost will be there. Okay, and when we are in the maturity phase, now we are constantly at top, so now the sales have reached the stable phase, like Apple. I think in today's world I can clearly see the unicorn Apple, because when it launches the products in the market, they generally grow in the growth phase, and they quickly go to the maturity phase where they have stable sales that remain stable for a pretty long time. And then primarily, so in this stage, like we discussed, which will be the major cost? Variable cost, because high sales means high variable cost. When we are in the decline phase, again your fixed cost will be a major cost, as well as your some variable cost also. So variable cost will here reverse will happen. Your variable cost will start declining because sales are declining, but you will have to incur some fixed costs, and that will start increasing, like dismantling, decommissioning, all these costs. Are we clear? Absolutely. Please put up in the chat box any questions and queries. Arana, I hope I'm clear. Okay, let's go forward. Now some exam pointers I've given that is going to be really useful for you when you're giving your exams. Number one, some costs are non-recurring one-off items, like non-recurring. Non-recurring means they are not the regular expenses, they're like one-time expense. For example, when you have design cost and prototype cost, and these are going to be substantial and quite a substantial portion of the total cost of the product, remember it. And they are generally non-recurring, because once you develop a prototype, you don't develop it again and again and again, right? Other costs are recurring, like production cost, like a distribution cost, like marketing cost. All this will be part of your life cycle cost. Then life cycle cost can be applied to services as well as customers, projects, everything. You can apply this concept to any costing that you are doing. Okay, so summary, what kind of cost will be covered here? In your life cycle costing, we will have cost like design, prototype, testing, equipment, setup cost, quality testing cost, all that. Then when you buy patents and rights, so any technical data cost, any training cost of the operator and to update skills, any manufacturing cost, any distribution cost, marketing cost, inventory cost, as well as cleanup and the end of life cycle costs. So start from the birth of a product until the end of the product. Every cost will be covered here. Okay, when you compare between a traditional costing and life cycle costing lines, let's have a quick recap. So in traditional costing, typically we look at only 1 year data, right? Typically we just look at 1 year 1 year data. And life cycle costing, we look at the entire life cycle of the cost. It may be 1 year, 6 months, 2 years, 4 years, whatever it is. Focus is on manufacturing stage only. When we do a traditional costing, that means we calculate the cost of the product, we add margin, and then we sell it at a selling price, right? But in life cycle costing, we focus at all the stages, not just the manufacturing stage, from design to disposal. Then we in the normal costing, we never consider the designing cost and the disposal cost. We only look at the in between regular manufacturing cost. But in life cycle costing, we covered that as well. In traditional costing, profitability is measured only for a short period, but in life cycle costing, we try to calculate profitability over the entire product's life cycle. So it's a major uh, you know difference between the two. Yeah, so I hope I'm clear till this point. Okay, let's look at some question, guys. Okay, now we have a question and let's do the calculations. So let's see how do we calculate the life cycle of a product. I hope everybody is with me on the screen. So let's calculate the life cycle of a product. Okay, let's read the question. Solution developed a new computer game during the year 20x2 for for 2 lakhs. Okay, the game will be launched in the year 20x3. Budgeted revenue and cost of the game is given to you. Over its life cycle is given to you. Now, what is it? Like sales units, revenue. This is the total revenue, variable cost, contribution. Contribution is sales less variable cost, right? Contribution is given to you, which is simply you can say 160 minus 30. Then from this, so you can underline it here. Okay, and from contribution, when you reduce the marketing cost, we get our annual profit. When you add the profits over on year basis, you get your cumulative profit. Clear? Now the question is, what is the life cycle cost per unit and what is the profit per unit of the product? Let's do the calculations. So for that life cycle cost per unit, I need to calculate what is the total cost for the product. Which are the total cost here? First, I need to calculate what is the total development cost. What is the total, wait. First, I need to calculate what is the total marketing cost, what is the total development cost, and accordingly, I will get the total cost of the product. Okay, let's do the calculations. So, development cost is given to you here through 100,000 because the figures are in thousands, right? So, 200,000 is given to you. For marketing cost, it will be total 40 plus 30, 70,000. And we have contribution also here, but then I need life cycle cost, so I need to add the variable cost. See, add the total variable cost 30,000 plus 65,000 plus 20,000, and I get here 115,000. So I've got the total cost of 115,000 also. Is there any other cost? I've covered variable cost, marketing cost and development cost. No other cost. Get the totals and get the total life cycle cost. So total life cycle cost will be 115,000 plus 70,000 and plus 2 lakhs. So I get here 3,85,000. Now this 3,85,000 you divide by total number of units. So total number of units are 16,000 plus 34,000 and plus 12,000. So total units I get here is 62,000. The question requires me to calculate per unit life cycle cost. So the total life cycle cost divided by 62,000 and I get the cost per unit as 6.21. How will you get the profit per unit? So that's very simple. You have got the total cost, now reduce from the total cost, reduce total cost from total revenue. Your total revenue is 160 plus 340 and plus 120. That is 6,20,000. Now when you remove 6,20,000, you remove 3,85,000, right? This is the total cost. So I get my total profit as 2,35,000. So profit per unit will be 2,35,000 divided by 62,000, which is equal to 3.79 per unit. Clear? So I hope I'm very clear with this, that now I got my life cycle cost and the profit cost per unit, profit per unit. Okay, let's look at one more question. Let's look at some MCQs now. So I think that will give you a quick understanding into this topic. Right? Before we do one more practical question, let's do an MCQ quickly. When are the majority of a product's life cycle cost usually incurred? Answer this. Yeah. Okay, so let's look at what will be the answer, guys. Your answer would be A. Absolutely correct. Why? Because I told you that the major expenses are always incurred at the design and the development stage. The major expenses like the development of a product, design of a product, advertisement expenses, your non-current assets, the procurement of material, the production process, all this will be there at the design and development phase. Hence, it is the phase where you have maximum expenses incurred. Let's go to question number 2. Which of the following costs are included in the calculation of a product's life cycle? Let's see which of the costs are included. Planning and concept design cost, yes. Preliminary and detailed design cost, yes, all design costs are covered. Testing cost, yes. Production cost, yes. Distribution and customer service cost, yes. So all. So my answer would be D, all. Clear? Now, let's look at this question also, and it is about Helios specializes in the manufacture of solar panels. It is planning to introduce a new slimline solar panel specially designed for small houses. Development of the new panel is to begin shortly, and Helios is in the process of determining the price of the panel. It is expecting the new product to have the following cost. This is the units manufactured and sold. This is the R&D cost, marketing, production cost per unit it is, not the total cost. Customer service cost again per unit, and disposal of specialist equipment. The marketing director believes that the customer will be ready to pay 500 for a solar panel, but the financial director believes this will not cover all the costs throughout the life cycle. So we need to see whether 500 per unit will be justifying with the life cycle cost or not. Okay, that we need to find out. So calculate the cost per unit looking at the whole life cycle and comment on the suggested price. Let's calculate the entire life cycle cost. So I will take the R&D cost. Total it is given. I will add it 19 plus 1 is 20 lakhs. Then marketing cost I will add 1 lakh 75,000 plus 50 is 2 lakh 25 plus 10 is 2 lakh 35,000. Now next I will take up the next one, which is, now this is cost per unit. So I need to multiply to get the total cost. 500 into 2000. That will be 10 lakhs. 450 into 15,000. This is the number of units. So 450 into 15,000 is 67. 67 lakh 50,000. Then 400 into 20,000. That will be 400 multiplied by 20,000. I get 80 lakhs. Then 450 into 5,000. And I get here 22 lakh 50,000. Now get the totals. So I will add here 10 lakhs. I will add here 67 lakh 50,000. I will add here 80 lakhs. And I will add here 22 lakh 50,000. So I get here 18,000. So I can simply write, I think I will eliminate the thousands then. It is becoming too heavy for me. So it is like 2000, it is like 235, and I will write here 18,000. The figures are in thousands. Clear? Okay, now we look at the next one. So here I've got 2000, here I've got this, and let's get the total cost for this as well. So customer service cost is also given per unit multiplied by the number of units, which is 2000, here 15,000, here 20,000, and here 5,000. Let's get it. 50 into 2000 will be 1 lakh. Here it will be 40 into 15,000. 6 lakhs. 40 into 20,000. 8 lakhs. 40 into 5,000. 2 lakhs. So now you add it. So we add 1 lakh plus 6 lakhs plus 8 lakhs plus 2 lakhs. Figures in thousands, it is 1700. Okay, now here it is total 3000, figures in thousands is 300. Clear? Now we add everything and let's see. 2000 plus 235 plus 18,000 plus 1700 plus 300. I get here triple two three five. Triple two three five thousand is a total cost. So what is the cost per unit? For net this, I need to get the total of units as well. 2000 plus 15,000 plus 20,000 and plus 5,000. I get here 42,000. If I keep figures in thousands, it is 42. So let's divide it by 42 to get the life cycle cost per unit. It will be triple two three five divided by 42. I get here triple two three five divided by 42. I get here 529.40. Now tell me, is the price correct? No. This is the price that the marketing director has given is wrong, because it is not covering the complete life cycle cost of a product per unit. Hence the price should be changed and revised, and minimum 529.4 should be there to cover the cost over the entire life cycle of the product. Done? I'm very sure now life cycle costing is absolutely 100% crystal clear to all of you. Let's move on to the next one and let's cover the next topic, which is target costing. So all of you be with me for target costing. Let's just take a 2 minutes break and then we begin with target costing. Yes, guys, let's continue with target costing. Okay, in the meantime, if you have any questions and queries, you're free to ask them in the chat box. Okay, let's continue with target costing. It is again one of another method to cost for a product. Now, when do we apply target costing? Let's say you are in a very competitive market. Okay, let's say you open a shop in your local community. Okay, and what you are selling is clothes. There is another multiple clothes shops in your area. Now, let's say you want to sell a T-shirt at 300 rupees. There are already the other sellers of the products that are of these products that are almost selling similar product, similar t-shirt at, let's say, about 275. Now if you're selling the similar kind of a product at 300 because you think your costing is high of sourcing it, so you want to cover your entire cost and the entire profit, and now you want to sell the product at 300. Do you think you will be having takers in the market? Probably no. At least not in the local market where you are selling the goods. Because people will always question that when I'm finding the similar kind of a t-shirt at 275, why would I go for your product at 300? Even if you maybe give a reason that the prints are so pretty and all that, but if it is similar kind of a product, then probably for the customers it would really not make much of a difference to go for a different product which is almost similar at a lower price. So they would then prefer 275 instead of you having 300. What will be the repercussion and the impact? The impact would be that now you would be forced to reduce the cost of your product to 275. Sorry, not the cost, my bad, the selling price of the product to 275. But then comes the question, ma'am, how would the cost be recovered? Because cost is going to be affected by 25 decrease, or I will have to reduce the margin. Generally, margin is not something that you would try to reduce, because if you have lower profits and the shinked profits, then survival in the market becomes difficult. Correct? You would not be able to survive in the market. You need to take care of so many things. So then ultimately where the pressure is going? Pressure is going to reduce the cost. And this is the cost that we refer to as target cost. So target cost is simply the cost that you calculate by going reverse way. Normal way is to get cost, add profit and get the selling price. Now in the case of competitive environments, we go reverse. So first we will fix the selling price as per the market. Then we will reduce the margin that we desire. And then we will arrive at the target cost. Okay, target cost. The only point to consider here is that you would always focus as a business to reduce what we call as a cost gap. What is a cost gap? It is simply in our case the actual cost and the target cost. The same logic is applied here. See, every business will only we have fruitful position and will be able to flourish well, will be able to have very good margins if they are able to reduce this gap of actual cost and target cost. Because frankly they cannot go beyond target cost. If they go beyond target cost, their profits will be affected, because price is fixed. You cannot sell beyond it. You will have no takers in the market, or very reduced takers. So you'll have to reduce the price, reduce the cost only for that. Got it? Now for reducing the cost gap, some strategies we will be adopting in order to reduce this gap, because we need to know some ways, right, by which we can reduce the gap. First way that we can adopt to reduce the gap is to do a value analysis. To do a value analysis. Now what is value analysis? For you, I will just, for that I will take you here, because for that we need to understand what are value. What is a value? Value is the worth of a product, but everybody has a different thought thing, this different, I would say, worth of a product. For example, if it is a Picasso painting, even though there are other artists that can create the same painting that may just look like same, but Picasso painting is a Picasso painting. So even if it is selling like for some million dollars, then we don't go by what was the costing in making that painting, because of course it was made long time ago, and I'm sure the cost of the canvas and the paints was much lower than what the price the people are ready to pay. So it's just like I think recently only I got to know that a famous players, the football World Cup, FIFA World Cups, football was put on auction, and it was sold for some multi-million dollars, right? So like that, I think. Like this, I think you can find various examples in the history. So every item is having its different value. So let's look at the four values that we consider here. Number one is the use value. Use value is typically the value that I can associate with the product's capability of being used in the way that it is desired. Okay, what is the product's ability to perform its functions? For example, you have bought a washing machine to wash the clothes. So your use value is the value that the cost that you have incurred to buy that machine, and the purpose of that machine is to wash the clothes. So if it is washing the clothes properly, then your use value is served. Second is exchange value. Exchange value means what? That now I want to do a barter trade. So let's say I want to give a product to somebody, and in return I will get another product in exchange. So what is its market worth is your exchange value, correct? The product that you're giving up, what is the market worth? Like for example, I go to Cars 24 and I say that I want to sell off my car. No, it's no longer there. But there was a time when I would give my car to Cars 24. I would say, good, I want to leave aside Cars 24. Let's say I want to buy a new car and I go to Maruti Suzuki because I want to buy its car. So I say that you give me the new car, in exchange, you take this car, and in addition, I'll pay the cash, whatever is needed. So let's say they have assumed that my car's worth is around 2 lakhs. So 2 lakh is my exchange value. The value that as per the market, my asset can fetch when it is exchanged in the market with another product. Then it's cost value. Cost value is simple. What was the cost of manufacturing that product? Then it's esteem value. Like I told you, the Picasso painting. Like for example, owning a Rolls Royce, owning a Mercedes, owning any other high-end car, it's like it carries an esteem. And owning Apple iPhone also. Let's take that example. See, if Apple iPhone becomes very cheap, people probably will not be so much crazy about it. Why you have a craze? Because it's expensive. And owning Apple iPhone and showing that A symbol among your friends, I mean, it is just another level of craziness, right? People will be like, okay, you have Apple iPhone, right? And this version. So Apple iPhone carries an esteem value where people are really not different. They're indifferent about the pricing. So let's say Apple has fixed a price of 115,000. Even if they fix 120,000, the takers will not change. They will still have a craze for Apple iPhone. So that is the craze that they have. Got it? So the added appeal of the product that attracts the customers beyond. Yes, it is the added appeal of the product that attracts the customers beyond its use. Okay, beyond its normal use is your esteem value, the value that the customer attaches like a kind of a self-respect, kind of possession that they want to have, like the historical monument and the historical artifacts around, like the Picasso example that I gave you. Okay, so I hope we are able to understand the value analysis. Now, this is very important because you will only be able to get the cost of a product based upon what value is it serving. So, accordingly, we will see whether how can we close the cost gap. Okay, so now focus is on enhancing the use value. We say every time the focus of the organization is to enhance the use value, that is maximizing the usefulness of the product and the prestige value. Prestige is nothing but your esteem value, because this will ensure that the quality standards are high and the customer is satisfied. Like I gave you the example of Apple, they are not really worried about the cost, but they're worried, they're only looking for the best quality, so the customer satisfaction should not be affected. And focus should also be to increase their use value. See, for example, earlier the washing machines, they were not so automatic, right? We had a limited version in them wherein not every process was automatic. And now as the new technology is coming in, not just the process of washing clothes has become automatic. Now there is a drying and lot of other features that have also got added to it. Why they are doing it? To increase the usefulness of the product. We drive a car for, in the initial times, driving a car was just assumed to be a point of a luxury. So anybody, those who owned cars, they were supposed to have an esteem value. But now it has become a necessity. But to increase the usefulness of the product, now we have GPS link there, tracking link there, calling link there. All that systems have been linked there. So that means to increase the usefulness of the product. So the more the useful a product is, the accordingly the pricing can be set, then accordingly the cost will be calculated. Clear? So value analysis is a very important way to reduce the cost gap. Number two is value engineering. Value engineering simply means that when you want to make changes to the product, okay, when you want to make the changes to the product, but at the same time you don't want to compromise the quality of the product, so that even though your costing gets reduced, but the quality is not sacrificed. So in a way you are using the alternatives, right? You are using some replacements so that the cost gets reduced but the quality is still served in the best way. You have cars that are coming in, like Tata launched a car quite some time back where it was launched in the segment of 7-8 lakhs, but it was still proving the worth to the cars that were launched in other by other companies in the segment of around 15 lakhs. So even though the customer quality did not go down, but the cost came down substantially. So this is also one of the ways, and we adopt value engineering in the designing phase only. Makes sense, right? You can only make changes to the production design and the plan, and then only the cost of the product can go down. So value engineering is adopted in the designing phase only. Like for example, you will remove unnecessary parts or accessories or unnecessary stages in the production process so that the costing of the product goes down but overall quality gets maintained. I think one of the best examples I can also give you is like the nano car example, when it was launched in 1 lakh, because dreaming a car in 1 lakh, when you get a two-wheeler in 1 lakh, so getting the same services, the same quality at the reduced cost, and with the engine still being of Jaguar, but the other parts were used and they were sourced from various other parts of the world and India, so that the overall cost gets reduced. So the purpose was that even with a cheaper cost, we can produce a very high quality car, right? So I think that's the best example of value engineering that I can give you here. Clear? So we are clear with value engineering, we are clear with value analysis, we are clear with target cost and the cost gap. Let's go to the book. Let's take up this portion again over there and let's discuss questions. So in the book, I've always given you the summary also. So when you're in the book, you will find the summary after the end of every chapter so that you are clear with that concept. So here we are at the target costing. So what are the steps that you will do in application of target costing? Identify the product's features and the estimate expected sales. Set the target selling price using the market and the competitor data. Step 3, determine the required profit, which is your target profit. Okay, determine the target profit, and then calculate the target cost, which is this target selling price less target profit, and estimate the current cost of the production, get the cost gap, and close the cost gap by either redesigning or eliminating the waste and improving efficiency. That is simply value engineering. When you improve efficiency, that's value analysis. The objective is always to maintain high use, that is increasing the value, your use value of the product, increase the esteem value of the product while reducing the cost value, because of course we always aim to reduce the cost value. See, if your use value increases, no, your exchange value will automatically increase. So focus is never to increase exchange value, focus is always to increase the use value. I've given you multiple examples to understand that. And can we apply target costing to service industries? We can, but it is very difficult because generally the services are not standardized. Services are heterogeneous. You every time we provide a service is different from what we provided earlier. So it's always heterogeneous. They're not similar. So applying target costing is very difficult because getting a target selling price is different because services will have different conditions. But then yes, for example, if I want to fix the fees of the classes, then I know typically what is the fees prevailing in the market. So typically I would always set up a price which is up to that or lower than that, which you will always find in the classes here at BB Virtuals Global, that we always fix the prices of the classes which is lower, much lower than what is there for the other institutes, that typically, and the quality levels are maintained. Okay, let's look at the question now. Just some questions for better understanding. So I will take the target costing question, guys. Look at my screen. Okay, let's start with this question. I am taking question number 5 first. Okay, it's a very good question. So let's take up question number 5. EcoPet company produces deluxe bird cages. So they are producing deluxe bird cages. Okay. And now it is about to launch a premium bird cage, which it believes can be sold for 125 target selling price. EcoPet company demands a margin of 25% on sales, so which is going to be 125 multiplied by 25%, that is $31.25 that we can calculate. Right, that we can calculate. Okay, so we have calculated here the target selling price and the target profit. What is the cost information for the new cage is as follows: the steel rods, which is the material cost, roofing mesh, wire, labor, variable overhead. So this is all material cost, this is direct labor, and this is variable overhead. All this we will add, then we get the actual cost. Okay, what is the target cost? That's very simple. 125 multiplied by 75%, that is 93.75. Right, this is my target cost. Let's move on to the next one. What is the expected cost to make the cage? Expected cost, you need to add everything. So let's get the steel rod first. The cage needs 10 meter of good quality steel rods. EcoPet company can acquire this at a cost of 48. So simply for steel rods my cost is 48. Roofing meshes 2 meters are required. Roofing mesh cost 17.5 per meter. So 2 meters will be 17.5 multiplied by 2, which is 35. Then wire is needed 1 meter and the cost is 1.5. I will add 1.5 here. Then the labor is paid at a rate 7 per hour and we need 2 hours. So 14. Variable overhead will be incurred at the rate 1.5 per labor. Labor hours are 2, 1.5 into 2 is 3. So get the totals. 48 plus 35 plus 1.5 plus 14 and plus 3. So I get here 101.5. So my answer is 101.5. Clear? Let's go to the next one. Which two of the following options would be the most appropriate strategies for Ecopet company to close the cost gap? So remember that you have to remove all the unnecessary expenses, the ones that we don't need, just remove them, or maybe just make changes without compromising the quality. Always remember it. Which two of the following can be adopted? Make the cage smaller. Yes, I think that can be one of the answers. Let's see the others. Raise the selling price, never, because you are in a competitive market. Make the windows brick bigger, increasing the proportion of wire and reducing the proportion of steel rods. When you see the wire, when we see the wire is at a cost of 1.5 per meter and the rod is 48 divided by 10. So per meter cost is 4.8. Yeah, so it costs less. Okay, I think this can be one of the answers. Use lower skill labor for all material. No, we don't need to compromise on the efficiency. Lower quality. No. So the answer is A and C. A and C are your correct answers. Okay, let's look at one more question to have better understanding. And I think I can take up this question. Question number 4th. Third one you can try at home. Okay, let's do question number 4. Elite Motor Limited is planning to develop a new model in its premium car range, the Z123 series, scheduled for launch next year. The car is expected to remain in production for 10 years. Developing and producing the new model, so it is going to remain in production for 10 years. So we need to get the life cycle cost for 10 years. No, sorry, it is the target cost. Developing and producing the new model will require an investment of 3 billion. So the investment required is 3 billion. The company aims to earn an annual profit of 20% on this investment. So the target profit is 3 billion multiplied by 20%. So what is 3 billion? It's like how many zeros? 1 billion, 6, 7, 7 plus 2, 9 zeros. Multiplied by 20%. So if I convert it into thousands, so I would need here required profit is again 9 zeros, 60. Okay. Wait, I think something wrong. So there are 2, 4, 6, 8, 9 zeros multiplied by 20%, and I get here 3, 3, 8 zeros. 3, 3, and 8. So I get here 6 billion. No, 60 lakhs. 60 million, sorry, 60 million I get here. Okay, market research suggests that car can be sold at a price of 40,000 per unit. Okay, and the company is expecting to sell 1 lakh units in a year. So if I keep the figures, now let's see what is the expected selling price. 40,000 into 1 lakh. So that gives me something around, let's keep the figures in 1 lakhs only. That gives me here 40,000. And here if I divide 1 lakh, it will give me 5000, 6,000. Okay, so what is the target cost per car? Then the target cost per car will be 40 minus 6,000, 34,000. That will be my target cost because this is the target selling price and this is the target profit. Clear, everybody? I hope now you're clear with, completely clear with the calculation of target cost, and handling this question in the exam will not be difficulty at all. So now I want you all to do the next question. And guys, I know the next question is, ma'am, where can we find these notes? You'll not find the book, my friend, but yes, these chapter notes for target costing and life cycle costing, I will be uploading them on my telegram channel. So if you're not subscribed to my channel, please subscribe to it. If you're not subscribed to my YouTube channel, guys, I need you to subscribe to it because I'll keep sharing a lot of videos, a lot of content that I'm sure going to help you for your exams. But then to excel exams, you need to have conceptual clarity of 100% of the subject as well as a lot of detailed question practice. As apart from this book questions, there will be a question bank that I've created that I'm going to share with all of you once you enroll with the classes. Plus the handwritten notes also, which is like a summary for all of you when you're revising. This will also be shared in the class. So we'll do ample question practice, live sessions, doubt sessions, revision sessions. Lot of all these will be there in the sessions. So all of you, if you want to watch more of the demo videos, you can see the demo videos which are already uploaded in my playlist of MA and PM, for the last quarter, that you can check out there also for more topics. And now I hope that I see you in the class. So like and subscribe my channel and enroll quickly at bbvirtualsglobal.com. See you in the live class. Bye bye. Take care.